Hi scholars, today's EMS lesson is for grade 9 learners. However, if you're in grade 8, don't skip this video, okay? It is still applicable to you. So for my lessons going forward, I will only be covering financial literacy. So whether it's for grade 7, grade 8, or grade 9, I won't do the economy and other things like that. It's just going to be financial literacy. This is lesson 1 for term 1, week 4. Right, so this is an accounting equation. So we already know that an asset is something valuable that a person or a business owns that can be converted into cash or will provide a future benefit. So all in all, the most important thing to know about an asset is that it is valuable, which means it costs something or has a price, meaning that it is all about money. We've got non-current assets and current assets. So we'll start with the non-current assets. So non-current assets are assets that a business owns and aims to keep for or use for a period longer than a year. And those assets are not easily converted into cash. For example, let's take land and buildings. So if a business owner wishes to sell the property, there's a lot that goes into it, and it takes time. It's not sold just like buying a loaf of bread over the counter, right? It takes a long time. The owner has to find an agent, they have to advertise the property, sign an offer to purchase, wait for the banks to approve funding, go through property lawyers called conveyancers, and it has to be registered with the deeds office before you can even get your money. So it's a long process. It's not easily transferable. Not easily converted into cash. So here listed, we've got tangible or fixed assets. So tangible means something that you can touch and feel and see with your own eyes, right? So we've got land and buildings. We've got equipment and vehicles. Then we also have financial assets that fall under non-current assets. These are basically, let's say you put your money into a fixed deposit and it is fixed for a period longer than a year. So maybe let's say you fixed it for 2 years. You cannot get that money from the bank up until that time is up. All right. So it does fall under non-current assets. Moving on to current assets. So current assets are assets that are easily converted into cash, right? So they don't stay the same for a period longer than a year, so they just keep on changing. For example, you're trading stock, so you buy stock, you sell stock, and you buy more stock, so the number is not always the same. Your debtors control. Debtors control is basically when you sell on credit, the people that owe you money are your debtors. So debtors control is that. So when people owe you money, it is an asset because you are going to receive that money back, right? A bank, so that is the money that you have in the bank. Your cash flow, it's the money that you have in your cash register or till. And then petty cash, that is the money that you keep for like little things that you might need. Let's say you run out of staples or something like that, so you can just easily access that money and buy the staples that you need. We've covered assets. Now we move on to liabilities. A liability is basically a debt. So something that you owe that needs to be paid back. We've got different types of liabilities again, just like assets. We've got non-current liabilities and we have current liabilities. The non-current liabilities are liabilities that you need to pay for a period longer than a year. So if you take like a loan to, let's say, buy a vehicle, you are going to pay for it for 5 years or 6 years. It depends on the term. Yeah, so it takes you a period longer than a year to pay off that debt. Then we've got current liabilities. Current liabilities are liabilities that are due during the year, within the year. So, right, you've got creditors control. So when you as a business buy on credit, so you need to pay that money back, let's say within 30 days or 60 days, right? It can even go up to 90 days with interest. Another example of a current liability is a bank overdraft. So let's say I've got 200 rands in my account and I want to buy something that is worth 300 rands. I swipe my card and then it doesn't decline. I actually get that thing that I wanted, but I only had 200 rands in my account. When I look at my bank statement, I'm going to see that I now have minus 100. So that is a bank overdraft. So as soon as money goes into my account, the bank will take its money and then obviously with a bit of interest. And that is what a bank overdraft is. Owner's equity, also known as net worth. I think in grade 7, you should remember that you did the statement of net worth. So basically, this is when the business has basically taken all its assets, paid off all its debt, all its liabilities. So assets minus liabilities gives you net worth. There are two things that will increase the owner's equity, and there are two things that will decrease the owner's equity. So if you look at this table here, there are two things on the left and there are two things on the right. So the first one that will decrease the owner's equity is drawings. When an owner takes stock, right, without paying for it, it is regarded as drawings. So let's say I've got a tuck shop and I take knickknacks from my tuck shop. Those knickknacks have to be recorded in the books as drawings. This means that I, as the owner, now have less, yes, in the business. The next thing that will decrease the owner's equity is expenses or losses. Mind you, these things are not the same. Expenses are not the same as losses. I'll explain as we go along. So an expense is the cost of running a household or a business, except the cost of buying an asset. So if you plan to buy an asset or buy an asset, it cannot fall under expenses. But everything that you need to pay for, like the things that are listed here, your cost of sales, your rent expense, salaries and wages, stationery rates, insurance, water and electricity, advertising, bank charges, telephone, repairs, packing material, and donations are the things that you guys pay for, business rather pays for, in order to keep running smoothly. Donations are basically beyond your scope for now, so you don't need to concentrate much on donations because they've got tax implications. So that is a story for another day. Losses occur when your cost of sales are more than your sales. So what you spent to buy your products is basically more than what you get at the end. So your sales are less than your cost of sales. Now we get to the other side on the right, the two things that increase your owner's equity or the owner's net worth. So the first one is capital. Obviously, we said that capital is money or possessions that are invested into a business or money that is used to start a business. But it's not only used at the start of the business. So capital contributions can happen at any stage. So whenever an owner wants to contribute some more money into the business, it is still known as capital. The next, income and profit will also increase the owner's equity. So money that you get from your sales, from your current income. So if you run a business where you render services, a service business, we call it current income. You get your rent income if you are leasing or renting out your space to other people, the money that they pay. is rent income. Commission income obviously is when you earn a commission, and donations income also when people donate to you as a business. Now that we have a clearer understanding of the accounting concepts, we know what assets are, we know what owner's equity is, and we know what liabilities are, we'll be able to do the accounting equation. So the accounting equation is assets equals owner's equity plus liabilities. This is when the whole balancing thing comes in. I think in accounting, you've heard it a lot like, oh, my books don't balance, things don't balance. This is where we see if things balance or not. The assets have to equal owner's equity and liabilities. I'll give you a few examples in the next lesson. I hope you found this video informative. Feel free to add your questions. So like, subscribe, write down your questions, and I will surely answer your questions. You can also just also pop in your, let's say, your past papers, things that you want us to work out, and I'll help you with that as well. Thanks for watching.